Hi there, everyone, and welcome to this month's edition of On Track. I'm Rob McGregor, and as usual, bring you the monthly updates. This one is for all the figures to the end of June, so that's the end of the financial year 2024, which allows us to do some good comparisons with the rest of the world, the rest of the market. We're recording this on the 25th of July with news right up to date. Firstly, before I get started, just the usual warning. Everything in this is what we would say general advice. It's aimed to be useful, particularly for clients of McGregor Wealth Management who use our care investment process and methodology. For everyone else, please do not act on anything talked about here without getting advice for yourself. So what we're going to cover today, all the usual stuff. We're going to have a look at what the market's been doing, what's happening in the world, particularly inflation, interest rates, and the economy, our eternal hot topics, what's happened with property and shares, and put it all in perspective. So yeah, highlights, lots going on. Shares hit a new high after we talked last month about them being in a trading range. And then they retreated a little bit, but still higher than they were a month ago for the most part. What a month in US politics. We had the great debate where Joe Biden didn't do himself very proud. Followed, a few weeks later by Donald Trump's attempted assassination, and eventually Joe Biden's resignation and the appointment, it looks like, of Kamala Harris to be the presidential nominee for the Democrats. So much going on. We've still got 4 months to go there. I'm going to talk more about that in today's On Track, because a lot of people get worried about big things like that and how they might impact the markets. Hold that thought. We'll talk about that shortly. Inflation remains stubborn in Australia last month, and it always comes out at the end of the month, so it'll come out in another week. But at the end of June, the monthly number, showed an annual inflation rate of 4%. That was up from 3.6%. The monthly numbers are not meant to be perfectly accurate. It doesn't include everything. So we'll watch the June numbers that come out at the end of July, which do include everything, to see where that trend is looking. But what it means is we're not seeing it drop down into that band of 2 to 3%, which the Reserve Bank would like to see it go. And that probably means we're not likely to see a cut. There are some analysts talking about potentially even an interest rate rise. I think if it went up more this month, that could be on the cards. The RBA is very aware of not crucifying the economy, not pushing into a recession, but they do need to slow inflation down. So watch this space. Inflation has slowed around the world. I show on this screen again the global inflation chart, all the colors here, and you can see the scary bit where it went up to 10% post-COVID, but it's back down. And Australia's at the top of that range at the moment of these major economies. In the UK, it's down at nearly 2%. Euro area is in the middle of the 2 to 3% band, and US just at the top of that 3% inflation there. You can see no change to the cash rate. 90-day bank bills are almost unchanged, up a little bit. 10-year government bond rate still fairly steady. So there's a typo there. Was 4.5% last month. Aussie dollar, pretty steady. We're hovering around that 66, 65 cent mark. US inflation, as I said, it is dropping. Mortgage rates, not much change. There's a few people teasing the market with some low offers. Macquarie's variable rate hasn't changed for quite a while now. Interestingly, their term deposit rate for 1 year popped up. A lot of competition for money over 1 year. Lots of specials on with all the online savers where you can get around 5-ish%. So that may well be short-lived. It may go for longer. Who knows? But it's good money on our cash at the moment. So let's have a look at the portfolios. And I'll start off by saying at our investment committee meeting last week, we pushed our dial up to 9. Now, at that stage, the market was at that new high. As I said, the market's come back a little bit, but we still hold it at 9. 9 just means it's in that fair to expensive mode. So it's not, these aren't things that mean we need to get out of the market. The market's got a wide range of valuations that it will trade through normally. This dial is mainly built for when we've got money on the move, is the way we call it. So that's when people are either about to pull money out or about to put money in. We just spread out the entry of those investments depending on where that is. So in other words, if someone shows up, they've just sold a property and they're new to the market at the moment, with the dial being at 9, we would just spread that in over 6 to 12 months. but it's certainly not alarming. And what happens often is as profits and other things increase, it kind of comes back to fair value, but that's where it is. So we've got performance numbers to the end of June, and I'll show you what other numbers in the industry, but pretty good numbers for care for the last year to the end of June, continuing to hit the targets. And last year looked to be a very good year. You can see if I go down the bottom for the full care when put together, you know, care high growth at 13%, an outstanding return. The growth at 12.5, balance 11.7, moderate 9.78. Big contributor from international shares, both in the core portfolios, but in the international portfolios, and big contributor from the active portfolio, which continues to do exceptionally well. You can see it's earned 10.45% over the last 7 years. I've shown here all the different asset classes, at least with an Australian hat on, and where they're at. So you can see in the last year, Australian cash earned you 4.3%, bonds 3.68, international bonds 2.67, international Australian listed property 24.65%. So a big rebound from some very troubled years. You can see the 5-year rate is still only 4% there. And the 5-year rates for everything is pretty ordinary because it includes that bond route where the value of conservative assets went down. International property, just 4% hedge. Aussie shares 12%, emerging markets 12, and international shares 19. Driven, as we've been talking about, largely by the Magnificent Seven and that AI sort of focus. Now, that Magnificent Seven did come back a bit in the last week or so, but not during the month of June. So in the AFR this month, I referred to a Chant West survey that comes out, and it does only look at the large super funds of more than, I think it's more than 50 billion, but don't quote me on that. And you can see the survey median was 9.1%, and this is for growth funds. Growth funds have a allocation of between 60 and 80% to Australian shares. So at the 60% level, that would be equivalent to our care balance, and at the 80% level to our care growth. And if you look at the returns of both care balance and growth, they both exceeded the top 10 funds published in this survey. So very happy with that comparative result, and exceeded the top fund there, which is Mine Super, the growth fund, which is the comparable one, by about 1.8%. So very pleasing, and continued in our goals to be above average in performance and below average in fees. So I threw this in. I was looking through some population. I go through the population stats. This comes out of this particular update, which came out, has a whole bunch of population statistics, but they're always out of date by 2 years because they relate from the last census. But this one is staggering. If we look at the proportion, and this is why we plan, this is why planning is so important for long retirements. But the proportion of people living until certain ages, between 1901 and 1910, and where we're at the moment. So in 1900, you only had a 1.65% chance of living to be 90 if you're a male, and 3.5% chance if you're a female. Right now, and this is from birth, there's a 28% chance that a male will live to 90 and a 42% chance that a female will live to 90. And I just sort of put that in to reiterate the importance of long-term planning. And as always, I touched on the wall of worry. Our last 20 years is the perfect illustration of the wall of worry, where we've had numerous drops, 12%, 17%, 17%, 12%, not counting COVID, but 15%. So 6 downturns of more than 12%, where we worried about stuff that eventually we stopped worrying about and the market stepped up again. This is why we call it the wall of worry. At some stage, we will stop worrying. We'll have a boom like we did in 2005, 6, 7. Inevitably, that boom will go too far and we'll have a bust. There's no sign of that boom at the moment, but that's how booms start, when there is no sign of it. So we never know when it's actually starting, and the importance of being in the market nearly all the time. Not much change in interest rates. As I said, the 10-year bond rates are now pretty much in the middle of their last 25 years. So they're neither high nor low. So as much as we talk about high interest rates, then you wouldn't say they're high compared to the last 25 years, nor would you say they're low. And they're hovering around. The reason we look at the 10-year bond yield is because it is considered the risk-free rate for investments, and that affects valuations of shares, property, and everything else. Because obviously shares and property need to get a much higher rate than that because of the risks that we take. Talked about the wall of worry there. I won't add anything more there. And I don't think I'll talk too much about the declines, where absolutely the last downturn for us was COVID. Well and truly recovered from that. Previous downturn was that the GFC 2007, which we recovered from in reasonably quick time. And as I said, this is a psychological um, cycle. So where we go from fear to greed, and greed is otherwise known as FOMO, fear of missing out. So the focus on our method up today, I'm going to talk about two things, but one single issue obsessions. We're going to come up to a very political year. I think it's the biggest year for democracy in the history of mankind. Some 4.5 billion people voting around the world in different countries. We've just seen a change of government in the UK, and we've got the US election in all its craziness coming up 4 months away. So I'm urging you to not get too stressed about single issues, as much as they may seem huge. And I'm going to put into context US politics compared to some of the few more recent elections. But the cost we know of people messing up their investments is massive. You know, it means that, and the Delbar study in the top right-hand corner there shows that people consistently get between 2 to 3% under what they should get just because they mess with their money for all the wrong reasons. Emphasizing that with the behavioral bias of the month, which I've done before, but these things are always worth repeating. But recency bias, and recency bias is just the bias that recent news or news that is more available clouds our opinion more than it should. We tend to think whatever's going on is way more important than it is just because it's recent, just because we've got the news available. And I will say this, the availability side of this here has changed as we've watched the last decade social media. The news is not the news anymore. We see a wide range of news. If you want to amuse yourself, as I sometimes do, watch the ABC current affairs program and then switch over and watch Sky News current affairs program. You'd think we're on two different planets looking at two different worlds. Just the biases that are built into those things and the lens through which we look at the world. It depends on the media we're watching. So this availability bias is now very focused. If you look at the US, we've got never been such a big split between Democrats and Republicans in terms of their opinions. And they all watch news that reinforces those opinions. So they each think the other one's crazy and making stuff up, but they're looking at completely different things. So it's fascinating to watch. It's a part of the modern world. We'll see where it ends. But I thought I'd go back and look at, we'll go back to 2016 when Donald Trump surprised everyone and he won the nomination for the Republican Party. And everyone thought, this is crazy. We've got this reality show guy who's got all sorts of issues, and all of a sudden he's the presidential nomination. And there was this fear. So back before the election, about this time, so 4 months before the election, during that time, there was this thought that Trump had no chance. So the polls showed Hillary Clinton a clear leader, and there was almost no chance of Trump getting in. Fast forward 4 months, and there was the thought that if Trump got in, the share market would crash because how is this guy going to manage the economy? So over the next 4 months, lots happened. You will have forgotten most of it, as have I. But Trump got in, just got in. Hillary Clinton and the Democrats were surprised. 12 days that stunned the nation, says this headline, as Clinton lost. And the stock market proceeded to go up 20%. So don't think, and I was reminded of this week when one of my clients said they'd been talking to a stockbroker who told them you better get more money in the stock market because Trump's going to get in, and if he gets in, the market's going to go up by 20%. Whenever you hear simplistic stuff like that, just run away from the source. The world just doesn't work that easy. If it worked that easy, we'd all be billionaires. 40 years in the share market has seen me learn, if nothing else, that anyone who tips with a high degree of certainty should be avoided because you just can't tell what's going to happen. So let's fast forward to the last month. Biden and Trump had their debate. Biden mumbled a lot, forgot stuff, looked terrible. And all of a sudden, there was the analysis, the headline here, what the polls show 11 days after the Biden-Trump debate, and all of a sudden, Trump was way in the lead and a certainty to get in. A couple of weeks later, we had the bizarre and horrible assassination attempt, and that this photo, like it or not, will be iconic in our future history as we look back. And we don't know what's going to happen next with regard to the election, but all of a sudden, the so-called sympathy vote was going to go to Trump, and all of a sudden, Trump was even more of a favorite. Biden was hanging on, but then, Biden steps aside, appoints Kamala Harris, and all of a sudden, this is yesterday, so July 24th, exclusive. Harris leads Trump 44% to 42% in the polls. Now, keep in mind, polls don't get it right. Polls miss a lot of things, but what a turnaround in a month. There's a long way to go. We'll watch this space. And either way, it will probably not have as much impact on the market as people think, for all sorts of reasons. Presidents can't just change things willy-nilly. There's Congress, there's Senate. They've got to get stuff through. It will definitely have an impact, but we'll see. Watch the market. The market will tell you whether they're worried or not. At the moment, the market is not worried. It's going about its business because capitalism gets up every day and does stuff regardless of what the politicians are doing. So they're the pillar that I wanted to focus on this month. It's a boring one, but it's a beautiful one. Diversification. You saw the difference in returns there before, and I'll show it again on this chart down the bottom. But last year, who would have picked that property sector, which had been much depressed for the previous 3 years since COVID, bounced up on the share market? Now, the reality is the property market's still going through issues, but the share market's forward looking. So it's always looking over the hill, and it's saying we think this is going to come back, and maybe we overdid it a little bit. Now, this is a big issue for industry super funds. Industry super funds have a lot of unlisted property, unlisted infrastructure, and they did not write it down when the markets dropped in 22. So the industry super funds are lagging on performance. You saw those top performing funds, a lot of industry super funds in there. But last year, to the end of June, a lot of the leading industry super funds, Australian Super, etc., got about 8-ish% on their growth funds, comparing that to the 12% that we got. Part of that is because they're lagging because of the unlisted assets. If you have industry super fund, or if you have people that have industry super funds, they will probably lag for the next 2 years. This is a complicated topic, but we're very happy to talk to anyone that's got that. We watch this very closely. In terms of, I love this chart. Every few years I dive in. This one goes to the end of 23, and it's an American facing one, but it's got all those colors of different asset classes. So you can see on the right hand side, from the US point of view, for the last 20 years, large cap growth has outperformed the most with 11%, and that's the Googles, the Nvidias, etc., followed by small to mid cap, followed by large cap value, followed by REITs, which is property, diversified portfolio, doing okay. In the middle, then international shares, bonds, cash, and commodities down the bottom for the last 20 years. Now, the adage is don't assume whatever happened last year. And you can see this shows each year from top to bottom, and you can see just what a checkerboard it is as things jump around. But it hasn't been a great couple of decades for commodities. That is one consistent thing. Cash is usually at the bottom more than often, and shares rise to the top over time. But always an interesting chart to look at as we try and just do the basic things in diversification. So let's have a quick look at the markets here. And Australian share market finished the year up nearly 12%. For the month, it was up about another 1%. It went higher after the end of the month and has dropped back a little bit there, but still very healthy in terms of where it is. Commonwealth Bank has had a tremendous run. It's almost overtaking BHP as the biggest company in Australia and in the portfolios. Some people may consider it quite expensive. Only time ever tells there. But a good, solid year for Australian shares. Not crazy good, so but certainly above average, which is nice. Not as much as US shares, which with our Aussie dollar hat on, rose 24% in the last 12 months, up 2% for the month, once again to new highs before they've retreated a little bit. And if you look at the stocks here, the top stocks there, Microsoft, Apple, Nvidia, Amazon, Facebook, Google, and they're the ones that have driven this growth, particularly Nvidia. And there's other big tech stocks to a 24% return for the year. So it's absolutely contributed to the total portfolios. Global leaders, very similar. Some of the same stocks make up this here. So this is IOO, which is in the active portfolio, 27%. for just buying the top 100 companies in the world. And you can see the 10-year average there of 15%, spectacular over time. And you can see that in the growth over the last 10 years. The blue line here shows the growth of $10,000 invested, and with dividends being reinvested, and it's quadrupled over that period of time in IOO. So a great contributor to the portfolios. US small caps, the smaller mids, despite being stellar over the long run, have been fairly average over the last 3 years. Part of that was this switch from small and mid caps to those large caps. We're seeing that unwind a bit. So we saw it spike, but still not bouncing up. This is the engine of US growth, and it's a very important part of the portfolio because, as you saw from that diversification chart a few back, it will always be up near the top of the ladder over the long run, and still absolutely stellar over the long run. Emerging markets have been the opposite. They actually had a good year last year at 10.5%, a good month at 3.5%, but have been subdued over the previous 5 years, mainly driven by political uncertainty around China, in terms of how nicely China is playing with the rest of the world. And a large part of this is Hong Kong or China-based. Not all, there's other companies in there like Taiwan Semiconductor, from Taiwan, obviously, and Samsung from South Korea. But plenty of other Hong Kong stuff in there as well. And we still remain committed to emerging markets. Emerging markets have a long-term track record of growing faster than developed markets, as the economic growth is still at the moment. So the world economic growth is forecast at around 3.3%, by all the OECD and things like that. But emerging markets will grow in the 5 to 7% range, led by things like India and China at the top end, while developed world like Europe, a slower growth in the sort of 1.5 to 3% range. So emerging markets very important, and they will have their day. So we continue to be confidently holding them in the portfolios. Gold, spectacular year, 21%, not quite as much as international shares, but take that out, and it was the second highest performer, partly because of uncertainty. Gold loves uncertainty. Most of that uncertainty came through March to October, some of it around US politics and other things as well, US-China tensions, but we'll always continue to hold gold in that active portfolio as a diversifier against sort of risk. Let's have a look at the property market, and the property market's still at the top of the hill in terms of most Australian places. And then it's just always the question of, when does the next hill, well, are we at the top of the hill? Is the hill going to get bigger, or will there be a downturn before we go up again? CoreLogic / RP Data they publish weekly actually, but we show the results monthly here. Monthly is always hard to tell meaningful changes, but you can still see places like Adelaide, which has had a stellar year. Adelaide houses up 15% for the last, sorry, all dwellings. But houses up 15%, up another 1.6 for the month. The only negatives for the month were Hobart, and Melbourne, and which Melbourne's surprising. But Melbourne is being driven by one-off changes to the way they do land tax. So in most states, land tax only clicks in when you have a rateable value on a property of 500 to 800,000. All of a sudden, they lowered that in Melbourne to be 50,000. So every property owner in Melbourne, for their investment properties, paying land tax. So that's caused some people to ditch their properties. That will become the new normal after a while, and the property market will resume there. So potential opportunity, for Melbourne. And Melbourne's always been one of the fastest growing places in Australia, but the Victorian government has a high level of debt at the moment, and that will probably place a drag on the Melbourne and the Victorian economy for a little while. Stellar returns the last year. Perth up 23%, Brisbane up 16%. So great returns there. Sydney more subdued, but still a solid 6%. How high will it go? Who knows? That's the $1 million question. So here's the numbers of the prices, what those percentages mean. So the median price of a Sydney house is now 1.66 million. What's median? Median's the exact house in the middle. So it's not quite an average, but it's like an average. So 50% of properties in Sydney are worth more than 1.6 million, 50% below 1.6. In Melbourne, that's $1 million. That's one of the biggest gaps I've seen between Sydney and Melbourne. In the longer run, you would not expect that gap to stay as big as that, which probably tells us Melbourne's got more value than Sydney, but who knows? Brisbane's catching up quickly to Melbourne. That won't always last as well. Traditionally, Brisbane runs at somewhere between 50 and 80% of Sydney. So you can see back in June 23, it was just over 50%. It's a bit more than that now. Brisbane's often great buying when it's about half the value of Sydney on the medians. These are just rules of thumb, and as always, need to make sure it fits into your plan, etc. But solid without being spectacular earnings. Perth's been the story, 23% annual change based on these numbers for houses. The bottom right-hand corner is units, and rock solid as well for most of the country. Brisbane units up 18%, Adelaide 15%, Perth 25% for units over there. So some great returns on investors as Perth catches up to the other capital cities after lagging behind post the mining boom crash post GFC. Vacancy rates, which is the amount of rental properties that are vacant, continue to be super low. And this June 24, 1.3%. So same as this time last year, not fluctuating much. You can see a slight difference between the capital cities, and you look at somewhere like Darwin, which has now got an incredibly low vacancy rate, sub 1%. 2 to 3% is kind of considered normal vacancy rates. So we've seen extremely low vacancy rates in the last couple of years since COVID, and that's put pressure on the rental market. It's pushed rents up and led to what everyone's dubbed the housing crisis. And we fully expect the market will work that out over the next few years by building more houses, subdividing, splitting houses up, etc. And no doubt some government assistance. Hopefully that chips in the right places. Often it won't, but hopefully it does. Almost static mortgage market, so no change at all to these numbers from last month. You still expect, fixed rates at about 6.3%, variable rates about 6.8. You should be getting less than that. That's the headline rate. You should be getting 6.1, 6.2 on your mortgage rates. If you're not, you should be renegotiating or refinancing. Give us a yell. We've got some great mortgage brokers we work with. We'll happily go to work for you to get lower rates. 0.5% on $1 million loan is $5,000 a year. So highly worthwhile battling for that. I did have one of my brokers tell me that NAB at the moment have a 3-year fixed rate of about 5.8 or 5.9. So maybe we're seeing the banks starting to fight, thinking that rates are going to come down in the next little while. Property clock, Heron Todd White, and we'll have a performance property clock back next month, but it continues to show a lot of the country in a rising market. Not too many areas on the right side of those charts are falling, and some areas considered at the bottom of the market. In other words, they've had their rise and boom. Keep in mind, a property clock is not a uniform clock. Each hour, so to speak, isn't a year. Things can sit at the bottom of the market for a decade, literally. And that's why, if you are trying to time a market in property, which is extremely hard to do, but you're trying to buy in at the start of recovery and into a rising market. It's interesting that Sunshine Coast, obviously, where we are based, is back to, according to Heron Todd White, the start of recovery. That's been driven by continued population growth and a flight to. It's interesting. We've got Newcastle, Central Coast, Illawarra, and Sunshine Coast all at the start of that recovery. All are what I would call lifestyle cities, settled by the beach, and benefit from the sea changes moving there and retirees moving to retirement homes. So interesting. Let me jump to and wrap up as always. And I say this over and over again because it's so important. It's like saying to people, if you want to be healthier, eat less sugar and eat more vegetables. These principles actually work. Everyone in the modern world's always looking for shortcuts, but these principles work. And we've had some of our clients for 25 years now, so we've seen the outcomes of these. But yeah, in summing up, all investing is always best done as part of a real plan that's based on your goals and your life and what's important to you. Portfolio designed to meet those goals, and then we take a long-term view. But then once we can then manage all the simple, important stuff, get the asset allocation right, massive diversification, make sure you've got enough liquidity so you never sell at a bad time, and then low cost exposure for most growth markets, except occasionally when we think a market's out of whack, like with bonds, and occasionally we'll do with other things. So, and then we protect against that short-term volatility with reserves and dollar cost averaging and rebalancing regularly, which adds value over time. As always, only 3 ways to lose money when you get this stuff reasonably well done. Panic and selling, we just don't have clients that panic and sell these days. Having to sell, that's why it's important that we review everything regularly, so we're looking ahead to see when you might need money for the new cars, the holidays, whatever else it might be, so we can plan in advance and sell when it makes sense, when you're making money. And the last reason that people lose money is not properly diversified, as I talked about today. Your care portfolios are beautifully diversified. Diversification is just that bargain where you bargain away the right to make a killing in return for never being killed. Thank you for listening. I do appreciate your time. And as always, look forward to seeing you soon.